Let me tell you what happened to most Nigerian crypto traders in their first month. They learn what crypto is. They buy their first USDT. They study charts. They feel ready. Then they open their first trade. And within 2 weeks, sometimes within 2 days, their account is either significantly smaller or completely gone. Not because crypto is a scam, not because the market was unfair, not because they were unlucky, because nobody taught them the one skill that separates trader who survive from trader to blow up their accounts in 1 month. The skill is risk management, and in this video I'm going to teach you everything you need to know about it. What trade number, real Naira example, and a real simple system you can apply to every single trade you ever place from today forward. If you are able to make your first trade, do not touch that screen until you have watched this video completely. Risk management is not a supplement to a good trading. It is a good trading. Let us start with the most important question. Why do most Nigerians lose money? Why most Nigerian traders lose money? First, I want to be very honest with you guys here because this is something most crypto traders keep over to keep things exciting. Study all retail trading accounts globally consistently so that 7 and 80% of traders look money over time. That means if you put 100 randoms Nigerian in a room and all them started crypto trading in 12 months, only 20 to 30% would still have more money in their accounts. This is sobering statistics, but here is the critical insight. Now, the 20% who are profitable are smarter than the others. They did not have better strategy. They did not have insider information. But the single biggest difference between the profitable majority and the losing majority is this. One, the profitable trader every trade loss as a small control event. The losing trader allows single losses to be catastrophic. So now let me show you exactly what I mean in the real Naira. Now, now let me show you two Nigerian traders. First one is some started capital, completely different the outcome after 10 trades. Trader A has no risk management. Are you with me? Risks 20% of their accounts on each trade. But trader B has proper risk management. They risk 2% of their accounts on each trade. Now, both traders start with 100,000 in Naira. Both traders have the same losing streak, which is 5 consecutive losing trade. This happened to everyone, even professional. Now, let me calculate what happened to each one of them. Trader A, this is trader A. Firstly, I want you to be with me. Trader A risking 20% per trade, which is 20,000 per trade. So after loss one, he have 80,000 per trade. He have 80,000 remaining. After he logs two, he has 60,000 naira remaining. After he logs three, he has 40,000 naira remaining. After he logs four, he has 20,000 naira remaining. After lose five trade, he have zero naira, account completely gone. This is no strategy, no risk management. So now five losing trade, accounts destroy, their trader cannot continue again. GL is nothing left to trade with. Now for trader B risking 2% per trade, which is 2,000 per one trade. After he lose one trade, the money still remain 98,000. After he lose two, the money still remain 96,000. After he lose three, the money still remain 94,000. After loses four, the money still remain 92,000. After loses five, the money still remain 90,000. Now five losing trade, I can still ask 90,000 remaining. Now this trader can continue, this trader can recover, and this trader excel in the game. Say five losing trade, completely different outcomes. Trader A is finished. Trader B asks 90% of their capital intact and can continue trading and leaving the market for the others. Now, but the question is whether you will have losing trade you will ever trade it us. The question is whether your losing trade will be small enough that you can survive them and keep going. This is the entire argument for risk management. In one simple calculation, it is not complicated, it is not advanced, it is just mathematical applied with principle. Most professional trader call the 1 or 2%. It is simple. Number one is never risk more than 1 or 2% of your total trading account on any single trade. Let me show you exactly what this means. So differently account size, because I want to feel real and practical for you guys. Now, let me show you something. If your account, let's say your account is 20,000. Now 1% of this 20,000 is 200 per risk per trade. So 2% is 400. If your account is 50,000, 1% is 500 risk per trade. So 2% is 1,000. But if your account is 100,000, 1% is 1,000, 2% is 2,000. If your account is 500,000, 1% is 5,000 naira maximum risk per trade. So 2% is 10,000 maximum risk. Now write down your account size right now. Calculate your percent and your 2%. These two numbers are your risk parameters for every single trade you placed forever and ever. Because I know what some of you are thinking right now. Say 200 per trade, that is nothing. How will I ever make money risking only 200? I understand that thought completely. It feels too small. It feels like it will take forever. But here is the reality. The trader who starts with a disciplined small risk do not stay a small account forever. As their account grows, though profitable trader, their risk must grow proportionally. But a trader who starts with 20,000 and grow to 200,000 naira through disciplined trading now risking 2,000 to 4,000 per trade at the same 1 or 2% rule. The rule scales with your account. The discipline stays constant. The trade who try to shortcut this process by risking 20% to make fast money almost never hits to the point where they are trading large account because they lose everything because they get there. Now, let's go to trade, which is let's go to where we are calling stop loss. This is the practical tools that makes risk management possible in the stop loss. Now, firstly, a stop loss is an automatic order you place that closes your trade if the price move against you to a level you define. Think of it as a major seat. If the trade goes wrong, the stop loss ejects you automatically before the damage becomes catastrophes. Let me show you exactly how it works on a week chart, then to set on a Bybit. Now look at the Bitcoin chart I'm showing you right now. I'm going to walk you through a hypothetical trade sector to show you exactly how stop loss is working in practical. Now let us say Bitcoin is trading around 74,000 at this moment. You have analyzed the chart and identified a strong support. Let me bring horizontal level so that you will see what I'm talking about. This is support level. This is support level at 70,000 naira. So at 70,000, you believe this price will bounce from this support level and move higher. When the price come here back, you believe the price will back and go to this points very soon. So now you decided to enter at this 70,000 plus. Now let's bring another support. Let's bring another one. Now I am drawing these entry levels on the chart now. This is horizontal second line here. This one we start at our stop loss. So because your stop loss always go below the support level you identify. If the price breaks below support level, it means your analysis was wrong and the trade is no longer valid. So you want to exit before the loss gets larger. So you place your stop loss at this 69,000 to 39. So the distance between your entry, which is 70,000, and your stop loss, which is 69,000 to 30, is just 1,000 plus. Now, how much of your account are you risking? Remember your rule, maximum 2%. If your account is 100,000, maximum risk 2,000. This is where position signings come, and this is the calculation. Now, let's draw the line. Now, this is what I mean. Our calculation. Let's go back to our calculation. Let's go back to our calculation. Let me show you something here. Now, this page, the position sizing formula. This is what I'm teaching you here. Now, maximum risk amount divided by step. Lux distance equals position size. Now, let me break this down with our example. Your account is 100,000. Your maximum risk 2% is 2,000. Entry price at, let's say, $95,000 per Bitcoin. Stop loss price is 92,000 naira per Bitcoin. Now, stop loss distance is $95,000 $95,000 minus $92,000 equals $2,500. Now, if Bitcoin is at $95,000 and the current Naira exchange rate is approximately 1,000 per dollar, 1,006 per dollar, then 2,500 Naira per dollar, stop loss distance equals 4,000 Naira movements per full Bitcoin. Since we are trading on Bybit, we have in USD. So the stop loss distance is 2,500 in USD. Our maximum risk is 2,000. At 1,600 per dollar per $1, this is approximately 1.25 USDT maximum risk. Know that one first. Position size calculation. Now 1.25 USDT divided by 2,000 USDT. The stop loss distance equal 0.005 Bitcoin. So in this example, at these prices, with $100,000 account, you would buy 0.005 Bitcoin with 100,000 Naira account. If your stop loss is hit and the price falls to 92,500, that means you lose just 1.25 USD. Approximately you lose 2,000 Naira. Exactly you can risk. Not more, not less. Now, this is position sizing. This is how professional traders control their risk with mathematical precision regardless of emotion. This is how you become a professional trader. So I know that calculation look complex when you see it. So firstly, I know that one, that it looks complex when you first see it. But don't let me lie with you. Don't let me lie to you. You only need to do this calculation once per trade and it becomes automatically after few times. The numbers to always know before entering trade. Number one, what is my total account size in USDT? Number two, what is my maximum risk per trade? 1 or 2% of my account. Number three, where exactly is my stop loss? Number four, what is the distance in dollars between my entry and my stop loss? Number five is divide number two by number four to get your position size. Which number two is what is my maximum, which number four I give you is what is the distance in dollar. So you see these five numbers must be calculated before you enter any trade, not after. Before, if you cannot answer all the five questions, you are not ready to enter the trade. Now, let's change ourselves, take profits, and reach to reward ratio. Now, this is what I want to teach you guys right now. We are on TradingView right now. We have covered how to limit your losses with stop loss and position sizing here. Now, let's talk about how to make sure your wins are bigger than your losses, even when when you lose more trades than you win. This is called the risk to reward ratio, and it is one of the most powerful concepts in all the tradings. Now, going back to Bitcoin as an example, our entry right now is 70,000. As you can see, this is entry is 70,465 in dollars. Our stop loss right now is 69,114 in dollars. Now, where is our take profit? When I look at our take profit, which is almost 74,000 in dollars. I can see the next significant resistance is going to 80,000 probably, but I'm drawing this take profit level to the chart now, the green line above the entry. Now, the distance from entry to take profit is almost like 4,000 $4,000. 90 70,000 is almost 70 to 74 from here, which is 69,000, which is $69,239 to here, which is 70,465. It's just 1,000 plus. Now this is almost like 1:0. For every 1 unit we risk, we are aiming to make almost 2% of our trade or 3% of our losses. The ratio is the absolutely minimum you should expect on any trade as a beginner. Here is why this matter mathematically, and this will change how you think about trading forever and ever. Now, let's firstly, with a 1 to 2 risk to reward ratio, you only need to win 34% of your trade to be profitable. Let's assume you are trading this or Bitcoin and Bitcoin move around, you are using 5x leverage and Bitcoin move almost 2%, 2% a day. 2% a day is almost 15 is almost 10% in 5x, which means if Bitcoin move like 5% per day, that is almost 24%. And if you are using 10x leverage, Bitcoin move almost like 4% per day. That is almost like 40% per day, because you will multiply the percent by the leverage you are using. If you are using 10x leverage and any coin you are trading move against you 1%, that means you are losing 10% or you are winning 10%. If it's going positively, you are winning 10%. If it's going really negatively, you are winning 10%. Now, let me show you this calculation. Now, 10 trades, let's say 1 to 2 risk reward. Risk is equal to 1,000 per trade. Your targets have to be 2,000 per trade. If you win only 4 out of 10 trades, that means your win 4 trades times is 2,000 to 8,000 in profit. Losses is 6 trade times, which is just only 1,000 to 6,000 trades. Now, you see not results. 8,000 minus 6,000, that is only just 2,000 in profit. You lose 6 out of 10 trades. You are wrong 60% of the time and you still made money. This is the magic of risk to reward ratio. You don't need to be right most of the times to be profitable. You just need to make sure your wins are bigger than your losses. 5 trade times, that is just 1,000 to 5,000. Net profit, that is just 5,000. Profitable with a 50% win rate, profitable even with a 34% win rate. This is the framework that makes trading sustainable over the long times. Now, let's the daily losses. Let me explain what I mean by the daily losses with you guys. Because beyond the individual trade risks, there is one of the most risk management rules that Nigerian beginner absolutely must understand: the daily loss limit. The daily loss limit is the maximum amount you allow yourself to lose in a single trading day before you stop trading completely for that day. My recommendation for all beginners is never lose more than 5% on your account in a single day. Let's assume you are controlling 100,000 accounts. Your daily losses must not less than 5,000 in a day. The moment you lose in a single day reach 5,000, you close all the trade that day. You close the trade if you walk away from the screen for the rest of the day. Why this is so important is that because of a psychological pattern that destroys Nigerian trading accounts every single day, and all the beginners trading self, they call this revenge trading. Revenge trade is when you lose a trade and immediately open another trade trying to recover the loss. Then you lose that trade too. So you open another and another. Each trade gets larger and the emotional pressure grows. Within hours, a bad day becomes an account destroying a day. The day loss limit stop this spiral before it starts. When you hit your daily limit, the decision is already made. You stop, no emotional required. They will decide for you. This single habit will save you from trading accounts more time than any strategy ever will do. Place risk management checklist that you must go through before every single trade you place. Copy this down, put it somewhere. You will see it every time you trade. Follow it without exemption. Number one is, what is my total account size in USDT right now? Number two question is, where is my maximum risk for this trade? 1% for concept fish, 2% for standard, or never more than 2%. Number three is, what exactly is my entry price? This number four question you ask yourself is, where exactly is my stop loss? Is this below a key support level for a buy trade? Is it logical, not just a random number? Number five is, what is distance in dollar between my entry and my stop loss? Number six is, what is my position size? Maximum risk divided by stop loss distance. Where number seven is, where is my take profit? Is my risk reward ratio at least 1 to ratio 2? Where number eight is, have I already lost 5% of my account today? If yes, do not take this trade. Stop for the day. Number nine is, am I trading based on my analysis and plan, or am I trading because of emotion? FOMO or revenge, fear of missing out or revenge. Which the last question you have to ask yourself is, if this trade hits my stop loss, will I be okay? Will I be to continue trading tomorrow? If you cannot answer yes to number 10, your position size is too large, reduce this until the answer is yes. Only for completing this checklist should you submit any order at all. Now, Let me close with the five most common risk managements most Nigerians always make, or most beginners always make globally. Mistake one is moving the stop losses when the trade goes against you. Firstly is that you set your stop loss at a logical level. The price approaches it. Instead of letting the stop loss do this job, you move it to lower to give the trade more room. This is the most dangerous habit in trading. It defeats the entire purpose of having a stop loss. The stop loss is there to limit your loss. Moving it means you are now choosing to lose more. Never ever move a stop loss further away from your entry. Mistake two is not using a stop loss at all because you are confident in the trade. Confidence in the trade does not eliminate the possibility of being wrong. The market does not care of confidence how you are. Always use a stop loss every single trade, no exemption. Mistake three is using leverage before understanding risk management. You see, this leverage means you are trading with more money than you actually have. Borrow from the exchange. On Bybit and other exchange, you can trade with 10x or even more and 100x leverage. But for Nigerian beginners, or for, let me say, for beginners, do not use leverage until you have at least 6 months of trade spot trading experience. Leverage amplifies both gains and losses. With 10x leverage at a 10% move against you, wipe your entire position. Beginners who use leverage without understanding risk management blow their accounts within this. Start with zero leverage. Learn the basics. Proof your strategy works. They consider leverage very carefully much later. Mistake four is risk more after a winning streak. 5 winning trades in a row create overconfidence. Many beginners respond by doubling or tripling their risk per trade. Confused, they have already found a magical formula. Keep your risk percent constant regardless of recent result. Winning streaks end, losing streak also end. The rules still the same through both. Mistake five is calculate risk in dollars. We only raise 5,000 per trade and never revisit this number regardless of account size. If the accounts grow to 50,000, 50,000 is only 1%. This is actually good. But if the account drops to 30,000, 5,000 is nearly 17% per trade. This is catastrophic. Always calculate your risk percentage of your current account size, not as fixed Naira amounts. Now, let's go back to our trading view. Now, let us summarize everything from today. Risk management is the most important skills in trading. Most important than charts, as you are seeing, as we are reading like this. Most important than any strategy selection. Most important than which coins you choose. The 1 or 2% rule: never risk more than 2% of your account on any single trade. Position sizing: calculate your exact position size before every trade using the formula maximum risk divided by stop loss distance. Now, stop loss: always set a stop loss at a logical level before entering any trade. Never remove it or move it further away. Take profits: always define to your exit point before entry. Minimum 1 to 2 risks to reward ratio. Daily loss limits: stop trading for the day when you have lost 5% of your account, no exception. The pre-trade checklist: 10 questions before every single trade. If you cannot complete the checklist, you are not ready to trade. Use the checklist I gave you today for every single trade from the next point. In our next video 5, we are going to take everything from the first 4 videos and build your first complete trading strategy. A clear, repeatable system that uses everything you have learned: chart, support and resistance, trends and risk management to identify real trade sectors. If this video helped you, please share it to a Nigerian who is about to start crypto. In fact, share it to everybody throughout the world who is about to learn trading, and this information in this video could save them from losing their savings. Subscribe so you do not miss video 5. See you there. Thank you. My name is Native.